Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have David Cohen. He runs the HANDLS Index. He is an industry veteran, has been in the industry for a very, very long time, primarily building and creating strategies that can be utilized in ETFs. And the HANDLS Index is behind the ETF HNDL. It's a very successful ETF, but I could have talked to David for hours. We talked a little bit after the show as well. A wealth of knowledge. You're definitely going to want to listen to this episode with David Cohen. David, welcome to the show.
Thanks, Brad.
So you run the HANDLS indexes. Before we get into that, can you tell me about your background and how you got into the position you are today?
Sure, I'd love to. So I came out of the Chicago, ETF and mutual fund business that kind of there was this west wing in Chicago in the western suburbs, and a lot of that came out of a company called Nuveen that did a lot of stuff in the early 2000s and tried to get into the ETF business. And backtracked and went away. And things like PowerShares, a guy like Bruce Bond who created PowerShares, worked with him. Dave Hooton, who created Claymore ETFs, which later became Guggenheim ETFs. And I worked I worked for Dave at Claymore, and we created Claymore ETFs back in the day. And Christian Magoon, who's at Amplify. A lot of people it was quite a center of the ETF universe out in the western suburbs of Chicago. So I came from there, and we developed a lot of innovative products at Claymore back in the day. We were early to the game. We did the first brick ETF back in, I think it was 2003 or 2006, I think it was. We did a lot of first to market concepts, and that was things we focused on. And we brought the first multi-asset product, which was called the Yield Hog back in and did a lot of interesting products and went through that. And so there I met my partner, Matt Patterson, who he was, along with a couple of other gentlemen, created a concept called bullet shares indexes. And bullet shares became an enormously successful product in that it really addressed the bond market and made bonds, ETFs into act like bonds, not like bond funds. And so from there, we kind of learned that ETFs have to have kind of a purpose, and we focused on that, and that's where HANDLS kind of came.
So you ran around with like the originals of the ETF industry. It sounds like. I mean, you've been in the game for a very long time.
There's so many people were in this business in a long time. I mean, yeah, I rang the bell at the American Stock Exchange a few times.
Yeah.
So a lot of us did, and there are a lot of people out there, and a lot of us are still, in the game. And a lot of the innovation you're seeing is coming from those people and the people I worked with in those times. Yes. So yeah, it was pretty dynamic business a long time ago, and it's grown up quite fast.
Yeah. So what about personally? What do you like to do? When you're not working, what are some of your hobbies and things you like to do?
Well, I've taken up, as I was telling you before we started, we recently kind of bought a little gentleman's farm in the middle of Long Island, and we're redoing that, and we're raising birds and animals and things, and rescuing cats and dogs and things. It's a very peaceful existence, a little bit more relaxed than working on Wall Street.
Yeah, well, it's funny you say birds. My mother-in-law, 2 weeks ago, a baby crow fell out of a nest, and now she's raising it. I'm like, are you sure you can raise a crow? And the thing still comes back.
I don't go rescuing birds out in the middle of the wilderness, and certainly not crows.
Yeah, exactly. That's what I said. I said, you're nuts.
There's some crazy crows, but we have More like Long Island has a lot of feral cats that get rehoused and things like that. So the outdoor cat issues. So it's a nice way to kind of get in touch with nature.
Sure. Well, that's great. Good for you. So let's pivot a little bit to handles. So how did the indexes come about, and were you running strategies or were you running money on these strategies before they came indexes? Like, can you talk about the story of how this came about?
To be clear, my partner Matt and I come from the product development side. He's a securities lawyer. I worked in product development and came up with new ideas and concepts and new ways about how to bring. And a lot of what we did back in the Claymore days was closed-end funds. And we came out of the closed-end fund market. And Handles was really, and closed-end fund market it's an interesting nuanced part of the business where, a big company like a BlackRock or Eaton Vance or whatever will bring a fund to market and syndicate it through advisors and they'll distribute it. And then boom, they manage the money and they believe that in fact they have the money in perpetuity and they provide. Essentially, most of them are leveraged income strategies, or a large portion of them are. And from that has, there was a derivative market was born of packaging up these secondary closed-end fund markets and reselling those to investors. Right. So that's where we came from. That was kind of our market. That's one of the areas we focused on. And so as we did that and we went forward, we saw, okay, there's a real transition going on in the marketplace. And that transition is that people are going to retire. 10,000 people a day. You cannot miss where the salmon are going. They are going upstream. They're retiring. They need income. And we had 0% interest rates. Interest rates were really low.
Yep.
There was nothing in the marketplace. And we said, okay, closed-end funds have been a fantastic way for people to do leveraged income strategy. And packaging them has been very successful. Can we do it more efficiently through an open-end vehicle like an ETF? And that was essentially the concept behind HANDLS, was to essentially make a beta play of these packaged products of closed-end funds that were used to drive income strategy. But to be clear,
interesting. So
we never ran money. We didn't run the money. We were not portfolio managers. We are not portfolio managers now. We create indexes, and there's a reason why we create it.
Yeah. So
and you're supposed to.
Can you talk about? Yeah. So can you talk a little bit about the strategy behind Handles and how it operates?
Yeah, I'd be happy to. And let me I go back to what I was saying. Just finish what I was saying there, which was there's a reason why we like indexes, and that's because indexes have rules, and rules can't, and they don't change. They don't deviate. There is an argument in the world for active management for your product, your THLV, which I love. Fantastic fund, very well thought out, nicely done. And there is a room for that in the market. There's a place for that. There are also people who are, true believers in passive strategies, things like the S&P 500 or just buying, buy the market and this. And then there's room for things in between. And Handles tries to be in between, right? It's kind of in the middle. And the strategy is based on the fact that sometimes, the passives are right and sometimes the actives are right. Okay. And so there's two sides. And so one side is we call the core and one side we call the explore. The core is 70-30 fixed income equity. Okay. All the time. Rebalances every month. The explore side is made up of a handful of different income-based strategies that Dorsey Wright uses their algorithms to weight and select in the marketplace based off of a factor that has a proven, one of the proven factors in active management, which is momentum, right? They're very good at momentum strategy. So it plays off the two of those, but both of them are kind of in the same pinwheel, so to say, in terms of asset allocations. And so you can vary a little bit. There's a little bit of deviation, but the truth is that sometimes passive wins and sometimes active wins. And we wanted to be somewhere in the middle because what we're trying to do is focus on total return and not really focus on the components of total return, which are yield and price appreciation. Okay. Those two things are kind of they don't mean as much as the aggregate number, which is total return. It's the only number that really means. And so Handles is like, let's create a high risk adjusted return product or fund, or not a fund, but an index, so to say, or a portfolio, and how to use that to deliver an income strategy because it's based in an ETF.
That's it, and
Does that make
it's
sense?
actually funny. We were working on this idea called Stactical, which would combine static holdings like the SPY and some other things with
Yeah.
tacticals, very similar to what you do. It wasn't a yield play, but it was more of a take on when there's times where you should be strategic, there's times when you should be tactical, and how do you find when that time period is, which is very hard thing to do, but it's something we've been working on. So
It's really hard. You're right. And it's really hard to do that, not only to do that, but to do that and create something that people invest in a timely manner, because there's so much of the effect on going into something when it feels good, which is usually not the time you should go into something. But in fact, you should go into it when it doesn't feel good. And investors do the same things when they go in and out of our products and the funds and things that they buy is some things are designed to be long-term holdings and they're designed to look over the long term and smooth performance over a long time. And when you trade, you're actually working against yourself, because you can be right, you can be wrong, or you can be, dead. It's like, okay, well, make your trade and see if you're right. Make sure you're right, because trading's expensive.
yeah, yeah. I found that out early. When I thought day trading was fun until you blow up an account or two in college, and then you're like, all right, let's find a way to be invested more often than not. But back to Handles. So Handles 7 is an index that runs an ETF with the ticker HNDL. Can you talk about that strategy in particular? Because there's over $1 billion in that ETF.
Yes, that's correct. It was our first ETF, and it's really the idea behind Handles is we don't fancy ourselves to be stock pickers or things of that nature. It's just that's not what we do. That's not what we're so. We look at the market. And if you look at markets, Harry Markowitz, who was the father of modern portfolio theory, basically showed that diversification is the only free lunch in investing. And so what we were looking to do when we created this index that is tracked by the HNDL ETF is to have a very diversified portfolio. So, we used other ETFs, which gives us, in essence, somewhere in the neighborhood of exposure to 20,000 individual securities. I think we counted up one day. We were sitting around and saying, okay, how many are we? And we added them up, and it looked like about 20,000 when we ran the spreadsheet. And that's way more diversification than diversification needs. So we've answered that problem. And so the idea was how to create a good risk adjusted portfolio. And so when we did that, we looked historically at what was the best allocation over time, over the last 50, 60, 70 years. What allocation provided you the highest risk adjusted returns? Because Sharpe ratio is all that matters. We all understand that. That's the ride that you go on in investing. The data point at the end of the year of what the S&P did or what a stock did or what something did is the total return. But the ride is the volatility. And the volatility is risk adjusted returns. You want the smoothest ride you can. And so we looked historically, and it was 70% fixed income, 30% equity, which people can argue, okay, well, it was a great bond market, last 50, 60. Okay, well, things are cyclical. We don't know what the next 50 or 60 years are going to look like either. So, but we do know over the last 50 years or so, 70-30 had, let's say, about the best risk adjusted return. So that was the target kind of allocation within the portfolio. Now, what modern portfolio theory tells you is that you just leverage or deleverage the optimal portfolio, because there's no difference in the optimal portfolio, whether it's an income portfolio or regular portfolio. You just leverage or deleverage to increase to the risk level that you as an investor prefer. And so to get to where we thought we could deliver 7% over a period of time and through an index, what we needed to do was say, okay, you needed to have some form of leverage in that in order to do that. And that's another function that we've learned from closed. And that's another advantage that an ETF can bring, because the ETF brings a lot of really good advantages to investors. Number one, they're incredibly efficient. So the trading is very efficient. The reallocation is incredibly efficient. For an investor to run a portfolio and reallocate it on a monthly basis, it's very expensive and very time consuming and very complicated. But it's a very beneficial thing that portfolio managers do bring to the table. And then Handle does another thing, which is essentially through the index, it allocates a portion equal to 1/12 of 7%, or whatever the number is, the 7 number, on a monthly basis for distribution. It takes it out because the idea of buying yield or chasing yield is what gets most investors in trouble. Mm-hmm. And so we just said, let's start with the yield number and deliver the optimal portfolio and adjust the risk level to create the index that's going to deliver that. That's the concept. That's the strategy behind what we did. And we think it makes sense. And it has, made sense. Now, an index hasn't done 7% every year. It certainly didn't last year. But I challenge you to find anything that did. Or can't. There's nothing much you can do. It is a passive strategy. It is the market. But in 4 of the last 5 years, it's done, the index has delivered, and it's done pretty well. And again, that idea that total return is really the important thing and that yield is just a number. One of the things I like to illustrate or look back at is AT&T and the stock of AT&T. And if you look at that since over the last decade or so, or even 20 years, and it has people buy it because it's a yield stock. But, the total return hasn't been particularly good. In fact, It's been horrible, and they've just been returning your money to you over a period of time and diluting. So that's not to pick on AT&T. That's just to pick on chasing yield as a strat.
You said a lot of interesting things there that I want to touch base on and ask some follow-ups. So how does the leverage component work? I understand what you're doing in terms of leveraging and deleveraging, but this is a rules-based index. So what triggers a leveraging event and what triggers a deleveraging event?
There is no triggering on the leverage. The number of the handle triggers the leverage. The 5 handle is the base index. It's unlevered. The 7 handle is levered at 1 point. It's 23% leveraged, essentially, because it's a 1.3x version. And then the 10 handle is 2x. So that's two times leverage. So the numbers work proportionally. It's mostly just math. The whole thing's just
got it. That makes sense. Mm-hmm. Now the distribution or the yield side. So I read somewhere that there could be a more favorable tax treatment with the type of distribution that you're doing. I read that somewhere on the website. Yeah. I'm sure that's very situational, but could you explain that or how the distribution works?
Well, the way the and again, return of capital just in general is an accounting term. Okay, it's a measurement of accounting. And again, this is something else we learned from the closed-end fund industry, which is, being able to treating things as return of capital. MLPs have done this for years. It's a way of passing back or returning your principal. This happens to be a side effect of ETFs that I think a lot of people maybe are overlooking, which is an ETF can basically, because of the way the rebalancing aspect works, you can shift your long-term capital gains. You don't have to recognize them. You defer them, right? And that's why investors buy ETFs, is because their capital gains are deferred to the future, right? One of the positive things is you're not getting, your capital gains. You're not getting taxed on an annual basis. It's up to you to decide when you sell it. So because it's a total return strategy and you're looking at trying to deliver that return, whether it be through dividends or through, capital gains, there's an ability to essentially defer capital gains to the future and it becomes treated as return of capital. So some of the dividend is not even end up taxed at the end of the year. It's something that a lot of people think might be that I think with a lot of people treat it as being a negative, and it's not a negative. It's actually not bad at all, because returning, if you experience a gain, a capital gain, and you earn the income, you deliver the distribution, or you receive the distribution, then in fact, and you're not taxed on it, you defer it off into the future. You can defer it to a later date, and even potentially to when your estate settles at some point in time. You have a step up in cost basis. So the speed at which you return to capital can be a problem if some things, there's some things out there that are delivering return to capital very quickly, but minor amounts of return to capital are just attractive from a tax perspective.
Got it. No, thanks for that. I was trying to dig through the prospectus and understand that a little bit, but that was Thanks for clarifying that.
Yeah,
So
I think it's you have to. I mean, look, the issue of return of capital, it's very individual and very, but it's also not as scary as people think it should be. It's really, it's again, total return is what matters. If your fund is making, if your fund, whatever fund or your index, whatever it is that you're looking at, is earning more than than you're distributing, then you are doing well. If you're not, you're not. It doesn't matter.
right.
How they treat it from a tax perspective doesn't make any difference.
So you briefly touched on the Explore side of the portfolio, which is run by Dorsey Wright. Is that a go anywhere sleeve, or is there certain parameters of how that Explore portfolio works?
No, the different categories of the Explore portfolio that were chosen, which include they're areas that income investors tend to like to invest. So there's things in there like high yield bond. There's investment grade corporates. There's Build America bonds, which are taxable munis. There are covered call funds. JEPI is in there. There's a growth and income fund. So there's different things that people like to invest in. The part of having Dorsey Wright select them is that it's based on momentum within the market, which has actually been pretty good because they overweighted like MLPs in the last year. Who called that? It was good. It was a good move. Some of the things well, sometimes they do, sometimes they don't. In the end of the day, it adds value to the total performance over time.
Yeah, I mean, with any tactical strategy, you hope over 3 and 5 year cycle periods are delivering close to the benchmark with a smoother return and better Sharpe, as you put it.
Yes.
And if they're doing that, then that's all you can ask for. So you briefly touched on this as well, as far as the rebalance period. So you rebalance the strategic side, as you said, on a monthly basis. Does the Explore side,
the entire index is rebalanced on a monthly basis? Everything.
Okay, so that's a rebalance within your buckets, and then also a rebalance of the buckets.
Yeah. Yes.
Okay.
But not a change, and the constituents change on once a year. But and the constituent selection process is really only geared towards finding the least cost representatives of each of the areas. It's not overly robust in the selection process, but it did lead to some good funds. That in the index process we found some good.
Yeah. So if you're sitting down with someone talking about the Handles suite, where do you see this fitting inside an overall model portfolio? And can it be just a standalone strategy of one size fits all?
Well, I mean, theoretically, it's like the market. It's basically representative of the market. It's a 70% fixed income, 30% equity strategy that gives you most of the market representation. That's but portfolios are personal. They're not one size fits all. But the product or the concept, the Handles concept, was designed to deliver a high level of current income. I mean, it's basically designed to give you high income. That's it. That's what it's. If you want to depend on something delivering you income because it's defined by rules. These are the rules. It delivers 1/12 of 7% on a monthly basis back to you, and uses the ETF structure to rebalance and recalibrate and make sure everything's perfect on a monthly basis, and make sure you get your check is delivered on the day, whatever it's supposed to be delivered. This is how it works. These are the rules that follow. Alternatively, people can choose to go and chase yield. That invariably tends to end poorly when you chase the highest yielding items. This is really a benchmark for what I think it's a benchmark for what a 7% return should look like, or 7% yield should look like in the marketplace. And people can they can find something they like better or find something they like worse. I think they'll be hard pressed to find things on a risk adjusted basis that deliver better than a 70% fixed income, 30% equity, 1.3x leveraged index. It's a nice risk adjusted return.
So is there an environment or a market environment? I would assume an environment like 2022 might be a little bit difficult on the strategy. Is there certain environments where this works, really well, and it's a lot easier to make?
You're absolutely right. I mean, 2022 was a really bad environment for this for the product, and it was a bad environment for a lot of products. And what I take comfort in is the fact that over, I think it's what I hear once in 50 years that they both acted like that. Okay, I don't know. It's like the market's kind of pre-disastered on. Once in 50 years, we got it last. That was probably the worst of it. It tends to do, we're looking over a period of time. We would, if you look over the longer periods of time, balanced portfolios tend to outperform on a risk adjusted basis. It's just how they always do. And it doesn't matter if it's 70-30 or it's 65-35 or 75-25. It's hard to predict exactly what the future is going to be. But we do know from, that diversification is the only free lunch.
So let's pivot just a little bit. Let's talk about the marketing side of the index and the fund. How do you guys go about marketing and how are you out there kind of distributing? I know you're not involved with the portfolio management of the actual product or the ETF itself. You're the index provider. But you guys have done a really wonderful job, I think, with marketing and getting this out there. I mean, the AUM tells the story. So how are you guys out there marketing and telling the story and raising those assets?
Yeah, well, we have excellent partners on the fund side. Strategy Shares. These are gentlemen, David Miller, Michael Schoonover, and Jerry Szilagyi, who have built kind of a really impressive fund group through Catalyst and Strategy Shares and their various entities out. And they've done a lot of they do they're primarily responsible for marketing, distribution, and things of that nature. And they've done a really great job. I think it's a testament, but it's a testament to finding the right product and fitting it with the right firm. Okay. One of the things you asked me was why did we focus on indexes? You had asked me earlier about why we had focused on indexes. And that happens to be what we're really good at. And I like indexes because indexes are rules driven. And they, in my history of active management, I've experienced in the past active managers who didn't necessarily follow their own investment philosophy, whereas an index follows its own investment philosophy. And as long as it's well thought out and you live with the basic tenets and rules, it's going to be there and it's going to last and it's going to go on. And similarly, a distributor has to do what they do well, and they have their areas of expertise and things. And I think that this was a nice match for these two products. Now, what we did, from the perspectives, we were very keen on our story and our points and what the product was and what the product wasn't. Okay, it's not a guaranteed we're going to earn 7%. It's what's the best approach to try to take 7% out? How do you fit that into your market? How do you fit out, Mr. Advisor? Where am I going to go and get a 7%, constant return that's going to be a dependable, stream of risk adjusted return level with a dependable set of distribution. That's what ultimately somebody's looking for. So, it's matching up with the right distributor and the message and the product. And I think that was what it was. And it was having a consistent, rational story for why you were doing what you were doing. And I think the index does speak to that. The index does, force that kind of diligence in the process.
Yeah, it's funny you say you've seen active managers deviate from the process. One thing I've never understood, like everything we do is rules based. Our index is passive rules based, and I've never understood why an active manager would create a process and then deviate from the process if they've done all of the due diligence and testing on the front end to make sure that it was robust. It never ceases to amaze me how many times they want to go in and tweak things or change things just because maybe they had a bad run for a month or 2 months. I mean, it's just human nature.
I think it's the same thing that affects everybody else in the market, and that's fear and greed. And, and this time it's different. Those are the big, dangerous words. This time it's different. It's just not. Over time, it's not. Okay. Last year was unusual. It's an unusual year for everyone. The one thing that, my partner, Matt, at least points out, and he goes, hey, it makes a much better entry point, and it's true. The truth of the matter is corrections are good for the market because they make good entry. And if you enter at a proper time, you're in good shape.
Well, David, I really appreciate your time. I could talk to you for a long time, but we like to keep these to about 30 minutes so someone can listen to them on the way to work. But nice. I would love an opportunity to continue a dialogue with you and, continue to pick your brain on certain things. But before we go, where can people learn more about your firm, and where can people learn more about the Handles ETF?
We put out a monthly report that just takes all the constituents and shows the performances. It's pretty straightforward and simple to read. You can get that either on Catalyst Insights or NASDAQ or through our LinkedIn page, which is Handles Indexes. We have handlesindexes.com as a website that goes through and shows a lot of the things that we published and wrote about it. And we wrote those things 6 and 7 years ago. Those were not just written like now. We wrote those in advance of the concept, and it's nice that it proved out. But thank you very much. So Handles Indexes, which is HANDLSINDEXES. A nightmare of spelling. Unbelievably available.
Well, David, again, thank you very much for joining us. I appreciate your time. And again, I hope to run into you some point in future. And thanks for taking some time with me.
Thank you, Brad. Thanks for the time. Appreciate it.